Hey everyone, today on the final bar, we'll talk about this growth-led rally across the board. Names like Enphase, SolarEdge, Netflix, and others up double digits today. Really a rotation back to some of the growth stuff that had been so beaten down recently. At the very least, a huge mean reversion back into some underperforming names. At worst, potentially for the market environment, this is that jump higher before the next leg down, similar to February 2020. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here in a cloudy Redmond, Washington. Thanks for joining us every week after the close as we focus on the market environment using the power of StockCharts, using data visualization techniques, the technical analysis toolkit to better quantify investor behavior and try to understand what's happening in this uncertain market at uncertain times. Really an impressive rally off of beaten down levels for some names that I think many have written off. Some of the solar stocks like SolarEdge, renewable energy names like Plug Power, Enphase. These are ones that have rotated lower and been underperforming for quite some time, really jumping to the upside today. And the question is this the beginning of something bigger and more meaningful? Is this the first step of a multi-step recovery to regain the previous highs? The Nasdaq moving up over 3%, 3.4% today for the Nasdaq Composite. That's a decent move to the upside. So the question is, in this sort of environment, right? How do we differentiate the sort of dead cat bounce from something deeper, more significant? What concerns me about this environment, one of the charts we'll look about, is how closely we're mirroring right now to what we did at the February 2020 into March 2020 top. We had a pretty big sell-off and a nice recovery before the real pain started to begin. We'll try to look at some of those charts together today and see what conclusions we can draw. Now, we have great guests on this show. We had a lot of fun last week with three solid guests. More of the same coming up for you this week. Tomorrow, we have the guys from Go No Go Charts. That's Alex Cole and Tyler Wood coming to us from the New York area. On Wednesday, Julius DeKempener, founder of RRG Research, an expert in all things rotational. On Thursday the 3rd, we have Frank Capillari from Instanet, has a wide following in the institutional community. We'll see some of the charts and themes that he is sharing with some of his money manager clients. Should be some great special guests coming up through the remainder of this week. Let's continue on today's show with our market recap. So as I mentioned, certainly a nice move higher today. And I think the challenges for bulls, they will see this as a huge validation that the low is in. We have established the low on the S&P. We will not hit it again, and we're rotating back higher. And the evidence of the fact that consumer discretionary is up almost 4% today. Technology, communication services, both up over 2%. The challenge is this can, bear market rallies can be incredibly tempting and incredibly compelling, right? They can look really, really good coming out of those lows. But you have to remember when we bring up charts of things like SolarEdge, these are coming off of fairly beaten down levels, right? Here's a little preview chart of SolarEdge. This is one up day among many, many down days. I'm seeing more red than clear bars there. It shows you just the distribution you've seen up until today. But again, it's quite a move. There's no denying that that's a nice move higher. I think it's an important time to take a step back and look at some of the longer term trends. We'll try to do that on some of the charts together. Let's check in on what happened with the major averages. S&P closing around 45.15. That's up almost 2% from Friday's close. If you remember, Friday had the nice rally in the last hour, which really was a renewed sense of strength after a fairly choppy, uncertain week. Really, finished strong going into the close. Today, more of the same, sort of picking up right where we left off and moving higher through the end of the day. One other sort of confounding factor. Remember, this is the last day of the month here on January 31st. A lot of times you'll get some sort of cleanup window dressing sort of moves before the next month takes hold. There may be a little bit of that today for sure. The Nasdaq really gaining more than the other major averages. The Nasdaq composite up 3.4%. Mid cap and small caps both up as well and outperformed the S&P 500 today. And the VIX is back below 30, spiked above 30 last week, now back all the way down to around 25. Other asset classes very quickly. Actually, not a lot of movement in interest rates. Now there was movement, but at the end of the day, you really didn't change from where we were on Friday. The 10-year yield just around 178. It's about where we were Friday at the close. So no real move there. And the TLT was down about 0.5% today. The dollar index down 0.7%. And we've talked about some of the big picture charts to pay attention to. I think a lot of those charts are on this little section right here. Besides a chart of the S&P, I personally would be looking at a chart of the U.S. dollar and the chart of interest rate, chart of the 10-year yield, because I think those three charts will tell you most of what you probably need to know to understand the dynamics. There are stocks that can perform well in any situation, but understanding those three charts will tell you a lot about headwinds and tailwinds for particular themes, particular cap tiers, U.S. versus non-U.S. stocks, and much more. Gold having a pretty decent day with the GLD up 0.6%, silver up 0.4%, oil prices up as well. Energy was one of the worst performers in the S&P, although all 11 S&P sectors finished the day higher. Cryptocurrencies actually rallied go into the afternoon Eastern time here, with Bitcoin trading around 38,500 and Ether are all just below 2,700. Actually touched it just a little while ago. And again, the nice rallies off of some beaten down levels, and so it's a really important, I would argue, to remain steadfast to the long term trends, focus on the long term trends, and understand how today's jump fits into that big picture, which are both Bitcoin and Ethereum have actually had a fairly difficult run of things in the last month or two. Let's look at a chart of the S&P 500 and focus on what we're seeing there. The S&P on Friday closed right at its 200-day moving average. So the narrative, I would argue, the technical narrative last week was, first off, the close below the 200-day, which was the end of last week. I think that was last Friday's session. From there, you sort of had this choppy week. Look at how last week's bars are literally right in the same range. We pretty much chopped around through the course of the weeks. We had up weeks, we had up days, we had down days. At the end of the week, we really didn't gain anything, except we finished at the highs of the week, right? So we traded all the way down almost to 4,200, almost to that first Fibonacci support level, all in just over 12% off of all-time highs on an intraday basis, closed right back at the 200-day moving average. Today, we closed back above it. And things like this, things like the 200-day moving average, things like important support and resistance levels. If you're not trading the S&P, I think they tell you a lot about just the overall environment. A market that is unable to hold its 200-day moving average is a weak environment. An environment that's able to regain the 200-day, a little more encouraging. I'm thinking about my conversation with Jeff Hughes, which I think was on Thursday of last week. And also, to be honest with you, I think John Kosar had a very similar idea, this idea that you had the big run through much of last year, then we've settled into sort of this range. We on this show have been talking about 4,700. We've been talking about 4,300. Both of those guys had sort of different particular levels, but with that same general theme that we're more range bound now, and we're in a consolidation phase. And you wait to see whether we break below 4,300 or break below 47 or above 4,700 would be my sort of measure. Others could have some different particular levels, but I think that's the general way to think about this, right? We've had a drop now, and we've retested the lows from September. So either the lows from September fail, or the highs from November, December are eclipsed. One of those things will have to happen eventually. Don't neglect that third option, which is just we just chop around this range for quite some time. But when I think about this market, I think about the overall deterioration in momentum. That has me thinking more negative than positive. Also, our market trend model, which turned negative a couple weeks ago. It's worth noting, the biggest gainers today were things like, semiconductors did pretty well, but I want to highlight just very quickly renewable energy equipment. The biggest gainers today in the S&P were things like Enphase, up double digits, Solar Edge, up double digits. And it's worth noting a lot of these. So for example, Solar Edge bouncing right off of support, Plug Power right off of support from last year. Same with Enphase, all three of those names. So I would be amazed if you didn't, at the very least, get a bounce off of those lows. That's a key support level that obviously is pretty clear on the chart. The problem I have is, what if those start to break? 200, I think, is an incredibly important level on Solar Edge. I would be watching that very closely, particularly if you're in a name like that today. Our next segment is called Sector Setups. This is where we focus on the 11 S&P sectors. Think about how they're rotating relative to one another. It'll be good to have Julius de Kempener on the show Wednesday of this week. He created this visualization called RRG, the Relative Rotation Graph. His show is called Sector Spotlight. Does a great job of using this methodology and describing some tactics and approaches using it. I've followed Julius and his work for years, and have always appreciated a very simple way of understanding how the 11 sectors are rotating around the S&P 500 in the middle of the crosshairs. What you notice right off, I hope, is how energy is a clear outlier. And if you look at any performance metric looking at the 11 S&P sectors, it's sort of like energy and then everything else. And even with the rally today that you saw in some of those growth sectors, it's still been energy dominating year to date. Again, in the first month of the year, you have energy up double digits year to date, while other sectors are struggling to even get above zero and be in the green for the year. So energy has certainly been the story. You know, the argument is energy has had such a run. Do you get a mean reversion lower, get a bit of a pullback after a lot of those stocks appear overextended? Do you have a bounce higher in some of the growth stocks after they've been beaten down so much? Names like Netflix and Amazon and others. Today, you're certainly getting the growth rebound that we've talked about. Could be in store. You really haven't gotten a pullback, I would argue, in energy, particularly on a relative basis, are holding up pretty well here. You're giving back some of those relative gains today for sure, but overall, even up on a day like today. After that, if you look at what other sectors are emerging, I would point out a couple things. Number one, look how technology and consumer discretionary have certainly rotated away. You have consumer staples, utilities, even real estate rotating more into the leading quadrant. The financial sector just got into the leading quadrant, today with the move that you've seen. So it's been certainly a rotation away from growth into cyclicals. Now, what's interesting is if you look at the daily RRG, which is going to capture some of the shorter term movements, this is where you see some of the strength that you saw today. This is where you'll see things like technology, which is there in the improving quadrant, things like real estate in the improving quadrant. Energy, which is still the strongest, is actually rotating a little bit weaker. But notice how consumer discretionary is still relatively weak on the shorter term and the longer term time frame. So again, I think that longer thesis of value over growth, as a number of my guests have pointed out recently, as we've talked about, given the prospect of higher rates, I would see a day like today as an anomaly and not the norm of what we'll most likely see, assuming rates that can continue higher from here, which I think they're most likely would do. Looking at the 11 S&P sectors now on the candle glance function, and if you use the chart list feature on StockCharts, which you definitely should, if you view any list of tickers as a candle glance page, it looks like this, and it's a really cool way to look at all of the charts at the same time, to start to look at relative movements, to see what's working, what's not working, and start to determine which charts you want to dig into a little deeper. Now, a couple of the takeaways, so, number one, how many of these sectors and which sectors are above two upward sloping moving averages? And the answer is not many. Starting from the left, upper left, we have consumer staples above the upward sloping moving averages. Energy, clearly the top performer year to date and still above both moving averages. We have utilities, given the rally that you saw today, above the two upward sloping moving averages. That's it. Everything else is either below the 50-day or below the 200-day or both. So it's worth noting that even with the choppiness that we've seen, the rotation, with growth bouncing, look at how beaten down consumer discretionary is. Actually, the XLY didn't even regain its 200-day moving average. Even though the S&P did, the XLY is still below its 200-day moving average. So I hesitate when people talk about this, big recovery that started today. That is making a huge assumption that you're going to see a lot more days like you did today. I'm not sure. I can't guarantee certainly that would happen. Same with technology. Nice bounce back above the 200-day. That's encouraging. I'd want to see more sustainable moves, particularly a higher low. And that's something I think you'd want to see if you're getting really excited about these growth sectors starting to work and you think that's a theme that's going to play out. I would be looking for the next pullback, which is certainly bound to happen soon, probably, and look to see if you can establish a higher low. Compare that to things like consumer staples, which is actually above both of the moving averages and moving in the right direction. The relative strength not as impressive potentially, but overall the trend has certainly been improving over the last 6 to 8 weeks. Consumer staples has actually been a fairly decent place to be. It's interesting when we look at the energy sector, and I've mentioned this before. When you look at the absolute returns on energy, you can see this sort of sideways consolidation phase that we talked about for quite some time. When you look up in a technical analysis book for a big base breakout, if they talk about basing patterns and how those resolve to the upside, this might be a really good example for a future textbook. Sort of the big run higher, this consolidation phase where highs and lows are sort of even. You have this sort of sideways consolidation pattern. Then you break out of the base to the upside and then retest the breakout level from above and then resolve higher. Look how it did all of those things. It then broke above that first swing high after the breakout from October it's sort of checking all the boxes of a sector that has been, or a chart that has been in a consolidation phase and resolving that to the upside. That's why I think that sector is pretty impressive. What concerns me on charts like this is when you have a bearish divergence. I don't know if I probably could call this a bearish divergence, to be honest with you, with higher highs and lower peaks in momentum. I don't know if we can declare this sort of rally done just yet, but if you would move down from here, certainly suggests a bearish momentum divergence with higher highs in price, lower peaks in momentum. What's interesting when you talk about the energy sector, by the way, I was mentioning to one of my guests, I forget who, this may be the first time since I've been following the Scooter rankings, which is a number of years, where the top 10 stocks are all energy names. If you look from DVN all the way to Petrobras, which is number 10, the top 10 large cap scooter rank stocks are all energy stocks. And it certainly shows you how much of a rotation we've seen into energy. Now, if we look at DVN, which is the top ranked stock right now, you can see that it's pulled back a little bit just in the last couple of days. You can see that the price has been moving higher and the momentum is diverging a little bit, right? We have higher highs in price, lower peaks in momentum. That could mean we get a bit of a mean reversion here, mean reversion trade. We have energy stocks that have had a good run that pull back a little bit. You have the growthy stuff start to rally off of those lows, which we certainly saw today. My question, though, is how much of a long-term move is that, right? It's certainly a short-term move. You're seeing a rotation away from value back into some of the growth stuff. Question is how sustainable it is. We don't have time to go through many more charts here, but I encourage you. We have a lot of earnings this week. Through the course of the week on the show, we'll look at charts like Alphabet and Meta and Amazon and talk about their technical setups leading into and coming out of their earnings release. We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close for our show. A couple quick comments before we get to our next segment, Shifting Stocks. First off, we welcome your questions. We do a mailbag segment a couple times a week, all using questions that come from you, our viewers, things you're running into as you're analyzing your own charts, things you're hearing in social media, on financial television, whatever it is. Nothing's out of bounds, and share your questions with us. Email is the best way to get your questions to us. That's thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions and hope to answer one of yours in our next mailbag segment, which will be Tuesday of this week. Also, go to StockChartsTV.com. That's our on-demand platform. Such great content. All of our market outlook specials from Larry Williams, Martin Pring, and Bruce Frazier. A whole group of special guest experts that we had, events like The Pitch, and all of our regular daily and weekly shows, all for free, all on demand. Go to StockChartsTV.com or on your mobile device, just search for StockCharts TV on demand. Our next segment is called Shifting Stocks. I sort of jumped ahead in the last segment because I was looking at energy. I just wanted to get into some of those energy names. So I mentioned we wouldn't have time to get into some of the growth stuff. I think we will here. Let's get to it. But I just want to finish one of the thoughts that I was sort of rushing into just before the break. You know, when you look at something like Diamondback, which is ticker FANG, FANG, you know, a couple observations. You know, the long term, you can see why energy has been one of the better sectors, the best sector year to date, but one of the better sectors, over time. You can see how FANG, this stock has really started a stretch of outperformance in November of 2020. This is when cyclicals as a whole started to do pretty well. In the middle of 2021, you had that period where the FANG stocks really started to emerge. Stock charts like Microsoft and Alphabet really started to work. And a lot of the banks and energy names sort of gave back some of those previous gains, sold off a little bit. But then look at how these names like FANG rotated higher. Diamondback Energy making new absolute highs this year so far in January. New relative highs for sure as the relative strength has moved higher, giving back a little bit. And again, in the short term, what you see is a bit of a bearish momentum divergence. You saw one of those back in October, November, by the way, where FANG tried to make new highs on lower momentum. You saw a bit of a pullback after that, then resumed the uptrend. Once again, we see higher highs in price, lower peaks in momentum. A lot of the energy charts look kind of like that. So when you combine the bearish momentum divergence with the fact that, a lot of people would say they're overextended, they're recently overbought, they're overvalued, whatever word you would use to describe charts or stocks that have had good runs that most likely need to have a bit of a pullback. They're overdue for a pullback, is what a lot of people would say. I think energy sort of fits the bill for that. So I wouldn't disagree with the idea that you might get a brief pullback. The answer, the real question, though, I think, is what you do with that. And I would say the answer is you think of the long-term trend, which is overall very strong. You think of the overall, general narrative of the market with higher rates and implications for that. Energy tends to do pretty well late cycle with rates going higher. It seems to be a pretty good option. So I wouldn't be surprised if those end up being really good opportunities to get into some of these names that already had a pretty good run that are starting to weaken a little bit. Now you compare that chart with the chart of SolarEdge or some of these other names, right, that have had breaks lower. So while FANG is just having this nice year to date, solar names have actually come off a little bit. I didn't look at First Solar yet, FSLR, very similar. All these charts look almost identical in that they had pretty good moves into the fourth quarter, but then around October, November started to roll over a little bit. And this has come down from 120-ish to 70-ish in just about 2.5, 3 months almost. That's quite a give back from making new all-time highs there in November of last year. The question is, how much lower is it going to go? Right, a lot of these names hitting key support. Every one of those that I mentioned, particularly in this group, are bouncing off of support. I would have been much more so. I'm not surprised by the fact that we see a bounce today, given the fact that we were oversold, reaching previous support. I would be blown away if we did not get some sort of bounce there. But the question is, how much gain has really been made, right? You're gaining back 7% after losing a lot more than that on the way down. So you have to have a lot of more days like this to really show some material improvement. The mark of a chart in a downtrend is lower lows and lower highs, and that's what FSLR and all these other names have been doing. My question would be, can you make a higher low? One of two things most likely happens here, right? You have a bounce, which we're in the middle of, and then you have this next low. Do we break 70 and do you break support on those names, which I would argue is your sign that the market downtrend is not anywhere near done and you might have much more of a pullback? Or do we make a higher low? Do we actually put in a low above 70? And that could be a really encouraging sign for some of those growth stocks. And that might tell you that the growth recovery is not just going to be a day or two, but more like, a month or two. It might be more of a broader return to the strength of growth and again, I don't think, I still would argue that that the value types of sectors are most likely going to perform better as the months go by and the Fed starts raising rates, most likely. But those would be some of the lines in the sand I think are really important to watch. Not to completely butcher my plan for the show here, but I did want to mention, going back to the S&P 500 chart, I mentioned about what could how this could be just the first bounce before you see the next leg lower. And you saw with some of those growth stocks, clearly they've pulled back to support, just like the S&P itself did, right? Pulled back to support from September. And so we're getting a very reasonable and logical bounce off of those lows. Not that we are going to re-experience February to March of 2020. It certainly is a possibility. And I put a video on my YouTube channel called Market Misbehavior. Put a video on there last week, I think on Friday, sort of a choose your own adventure, 4 potential paths for the S&P and what that would look like. I'd encourage you to check that out if you haven't done so already. But if you look at what happened here in February of 2020, we had that first sell-off, which is a little more than what we see now. I think that was about 15 or so percent or so. I'm fudging the numbers here a bit, but a little more than the pullback we've seen so far year to date. Then you saw a nice bounce. This is about a 10% bounce off of the February low to where we hit that lower peak. Then you had the big move lower, and this is sort of the disbelief phase. This is the, I guess that was the bottom phase, and this is the, we're going to go a lot lower phase. And my concern on this market is right now is sort of that end of February of 2020, which is that first jump higher where a lot of people got drawn in. That's called a bear market rally, where your overall the trend is lower, but you have this sort of quick bounce off of the lows, and FOMO kicks in big time as people are desperate to not miss that next buyable dip. The problem is if this happens right after, and this is where all the people that bought in recognize that that was not the right answer and they start liquidating, and then things really can accelerate. So I can't guarantee that's going to happen. I don't know what's going to happen tomorrow or the next day, but I do know we're looking very similar to buyable dips. We're also looking very similar to that bear market rally phase, and it's all about if we can hold support. So I'd be eyeing 4,300 on the S&P, of course. Some of those growthy stocks that have pulled back, I'd be eyeing some of those particular support levels as well. Just to finish off our segment on shifting stocks, I wanted to mention some of the growth stuff that's going to be reporting earnings this week. And so you have Alphabet tomorrow after the close. That's Tuesday. You also have PayPal, by the way, and I'm mentioning two out of a ton of names, and there are 50 names that I jotted down in my Stock Traders Almanac this week to highlight tickers that I wanted to pay attention to related to earnings. But again, Alphabet is coming out of an oversold condition last week. Totally reasonable. You get a bounce right now today, testing the 200-day moving average from below. I would still argue a chart like this has a lot more to prove before you agree that the low is in and that 2,500 was the low. Making a higher low is the most convincing way that you can determine that that's been the case. On Wednesday after the close, you have Meta, and this is obviously a name that failed to break above 350 and now making a new swing low and undercutting some of the previous lows. This has been a pattern of lower highs and lower lows, and so that's certainly the pattern that I would look to break, right? Or when are you going to make a higher low? Can this put in a low above 300 when we pull back? Finally, on Thursday, you have Amazon. I'm mentioning the three FANG stocks, but there are many reporting earnings this week. Amazon is an interesting one. We'll talk about that in the 3 and 3 because one of those is Amazon. But certainly coming out at fairly depressed levels. As always, do we make a higher low or not? That's all the time we have for shifting stocks. So I want to move into our final segment, the 3 and 3, today brought to you by the good people at Chaikin Analytics. 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P 500, the daily chart. And again, it's kind of silly to feature this as one of the 3 and 3, but I just think it's super important to pay attention to. When I look at the market and what it's done, we've had a fairly significant drawdown, a deeper drawdown that we saw in all of last year. And the question is, how far is far enough, right? When do buyers start to come in, not just on one day, but on a series of days, right? One day does not make a trend. A series of days where you're showing renewed strength. It is totally reasonable. We would bounce off of 4,300. Whether or not you're bullish or bearish, that is probably what I would expect. The question is the next leg, and I'd be looking at 4,550 and at 4,300. I think one or both of those levels could come into play certainly through the rest of this week. Some big market moving earnings could certainly be the catalyst that tells us which way we're going to resolve. Chart number 2 is Apple. Obviously reporting last week, and I talked about Apple. I remember back here when we were having periods of market choppiness, but you saw Apple moving higher, and the general thought is, how bearish can you be when charts like Apple look good? And I would have to say, if I had to decide, is this a thumbs up or a thumbs down? It's sort of a thumbs up type of chart. This is sort of a resistance becomes support 101 type of chart, right? You hit resistance in September. We broke above it in November of last year, retested that a number of times. And then most recently, just last week, we retested, support around 155 and rotating higher. As long as 155 holds, this is a chart in a constructive phase. This is a chart in the accumulation phase. And overall, making new relative highs. And that's a huge name, right? That's one of the largest names in the U.S. So certainly it's hard to be too bearish when you have charts like Apple looking like they do. Amazon is our third chart in the 3 and 3. Coming out of oversold levels, a nice bounce today with many of the growth stocks clearly having a nice day today. And what's interesting about this one is the symmetrical nature of this chart. Look at how Amazon essentially has gone nowhere since July of 2020. Talk about a sideways trend when the market overall has done so well. That's why the relative strength is so consistently weak on Amazon. Why this is an interesting chart is because you've had failed breakouts, which we did in July of last year, which we did again in November of last year. An attempt to break above previous resistance. It looks like it's going to happen, but then you never really follow through. You go right back into the below the breakout level. We've now had arguably a failed breakdown. You broke below support around 2,900. We actually got below the first Fibonacci level, it's around 2,820, and now it's repelled that breakdown and we've bounced back above it, holding that 2,900 to 2,800 range. That's sort of the shaded area I would keep in mind. Those are the lows from the last couple of years, and it's also the first Fibonacci level. That holding would be key to an overall constructive thesis on stocks. Charts like Amazon break 2,800. I think this could be a dangerous environment very quickly. Folks, that is our show for today. Thank you so much for joining us every weekday live after the close for the final bar. As a reminder, go to all of our previous episodes, including some fantastic guest interviews at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.